World Reading Club. That's right. Day trading and economic equilibrium. Wealth attraction research. Day trading and economic equilibrium. You're listening to Wealth Attraction Research, WAR, WAR, Day Trading and Economic Equilibrium, presented by Hakeem Alibokis Alexander on Spreaker Social Podcasting, presented for World Reading Club in association with ExercisingYourMind.com and Uniquilibrium. This edition's reading focus comes to us from the Little Book of Economics, and the section is titled, A System of Free Markets is Stable, Economic Equilibrium, and from How Money Works, Day Trading. First, starting with the Little Book of Economics, A System of Free Markets is Stable. In context, the focus is markets and firms. Key thinker, Leon Walras, who lived 1834 to 1910. Before his time, in 1881, Francis Edgeworth publishes a mathematical assessment of economics in mathematical psychics. Mathematical psychics. All right. After that, in 1906, Vilfredo Pareto develops a new theory of equilibrium that takes account of the compatibility of individual incentives and constraints. The 1930s, John Hicks, Oscar Lange, Maurice Allais, Paul A. Samuelson, and others continue to develop the theory of general equilibrium. 1954, Kenneth Arrow and Gerard Debreu provide a mathematical proof of general equilibrium. There's long been something appealing for economists about the idea that the economy may behave with the same mathematical predictability of scientific laws, such as Newton's laws of motion. Newton's laws reduce the whole complex, teeming, physical universe to three simple, reliable mathematical relationships. Is it possible to find similar relationships in the complex, changing world of markets? In 1881, a British professor named Francis Edgeworth published Mathematical Psychics, an early mathematical work on economics. He realized that economics deals with relationships between variables, which means that it can be translated into equations. Edgeworth thought about economic benefits in utilitarian terms. In other words, believing that outcomes could be measured in terms of units of happiness or pleasure. Other economists were also intrigued by the idea of a mathematical approach. In Germany, the economist Johann von Thunen developed equations for a fair working wage and the most profitable use of land. In France, Leon Walras, an academic who would later be described as the greatest of all economists, was trying to discover a complete mathematical scientific framework for the entire discipline. Walras was ardent in his conviction that it was possible to discover economic laws that would make economics a pure moral science describing human behavior that went hand in hand with the pure natural science of Newton. His general equilibrium theory was devised to explain the production, consumption, and prices across an entire economy. Supply and demand. Hey, wasn't that the previous section that I read? Yes, it was. That was the previous section. Prices come from supply and demand. See earlier episodes of World Reading Club Wealth Attraction Research. Okay, continuing. Supply and demand. Or not see, maybe hear them. Listen to them. The previous episode, supply and demand. Okay, continuing. Supply and demand. Walras began by focusing on how exchanges worked, how the prices of goods, the quantity of goods, and the demand for goods interact. In other words, he was trying to pin down just how supply and demand tally. He believed that the value of something for sale depends essentially on its rarité, which means rarity. Rarité. Rarité. I don't know how you pronounce that in French, but it's spelled Rarete with the little the mark at the end of it. What I forgot that's called again. It'll come to me, but now it's not important. Which means rarity, but was used by Walras to express just how intensely something is needed. In this respect, Walras differed from many of his contemporaries, including Edgeworth and William Stanley Jevons, who believed that utility, either as pleasure or usefulness, is the key to value. Walras began to construct mathematical models to describe the relationship between supply and demand. These revealed that as price escalates, demand falls and supply climbs. Where demand and supply match, the market is in a state of equilibrium or balance. This reflected the same kind of simple balancing forces that were evident in Newton's laws of motion. All right, we got a little section here, another nice flow chart, some boxes here. The first one, starting at the top, shortages of supply in one area of the economy create surpluses of supply elsewhere. Down to the left, where there are shortages, prices rise. As prices rise, demand falls and supply rises, eliminating shortages. Finally, to the box, it says economies as a whole tend toward equilibrium as long as they are free to do so. A system of free markets is stable. Starting back at the first box again and then going down to the right, shortages of supply in one area of the economy create surpluses of supply elsewhere. Where there are surpluses, prices fall. As prices fall, demand rises and supply falls, eliminating surplus. And again, finally, economies as a whole tend toward equilibrium as long as they are free to do so. A system of free markets is stable. So let's look at this flowchart again side by side. At the top, shortages of supply in one area of the economy can create surpluses of supply elsewhere. To the left, it says, where there are shortages, prices rise. To the right, where there are surpluses, prices fall. Back to the left, as prices rise, demand falls, and supply rises, eliminating shortages. To the right, as prices fall, demand rises, and supply falls, eliminating surplus. And they finally go back again to economies as a whole tend toward equilibrium, as long as they are free to do so. A system of free markets is stable. And before continuing, I'll take a look at the spotlight of our key thinker, Leon Walras. And it says, Léon Esprit Léon Walras was born in Normandy, France in 1834. As a young man, he was captivated by Bohemian Paris, but his father persuaded him that one of the romantic tasks of the future was to make economics a science. His father persuaded him that one of the romantic tasks of the future was to make economics a science. Walras was convinced, though he maintained his bohemian life until, destitute, he went to Lausanne as an economics professor in 1870. It was there that he developed his theory of general equilibrium. Walras believed that the organization of society was a matter of art outside the scientific realm of economics. He had a strong sense of social justice and campaigned for land nationalization as a prelude to equal land distribution. In 1892, he retired to the town of Clarens, overlooking Lake Geneva, where he fished and thought about economics until he died in 1910. Okay. Key works, 1874 to 1877, Elements of Pure Economics. 1896, Studies in Social Economics. And 1898, Studies in Applied Economics. That was the spotlight on Leon Walras, the key thinker for this section, titled A System of Free Markets is Stable, Economic Equilibrium. Continuing, General Equilibrium. To illustrate this equilibrium, imagine that today the current market price of smartphones is $20. In a local market, store owners have 100 phones for which they want $20. If 100 buyers visit the market, each willing to pay $20, the market for cheap smartphones is in equilibrium because the supply and demand are perfectly balanced, with no shortages or surpluses. Walras went on to apply the idea of equilibrium to the whole economy in order to create a theory of general equilibrium. This was based on the assumption that when goods are in surplus in one area, the price must be too high. Prices are judged too high by comparison. So if one market's prices are too high, there must be another where prices are too low, causing a surplus in the higher priced market. Walras created a mathematical model for the whole economy, including goods such as chairs and wheat, and factors of production such as capital and labor. Everything was interlinked and dependent on everything else. He insisted that interdependency is key. Price changes do not take place in a vacuum. They only occur because of a change in supply or demand. Moreover, when prices change, everything else also changes. One small change in one part of the economy can ripple through the entire economy. For example, suppose that a war breaks out in a major oil-producing country. Prices of oil across the world will rise, which will have far-reaching effects on governments, firms, and individuals. From increased prices at gas stations and increased heating costs at home to being forced to cancel a now expensive vacation or business trip. Boo-hoo. I'm looking at a photo here, a guy holding, looks like is that a bull? What the hell is that? It says, an auctioneer takes bids at a cattle auction. Walras imagined an auctioneer who provides perfect information for the market. He announces prices, and a sale only takes place at the point of equilibrium. Sweet dreams, Mr. Walras. Continuing, there's a quote. There was a set of prices, one for each commodity, which would equate supply and demand for all commodities. Kenneth Arrow. Continuing, toward equilibrium. Walras succeeded in reducing his mathematical model of an economy to a few equations containing prices and quantities. He drew two conclusions from his work. The first was that a state of general equilibrium is theoretically possible. Wait a minute. How did this guy's father convince him? What did he say? His dad said his father persuaded him that one of the romantic tasks of the future was to make economics a science? Whose father does that to their child, and why? And what is going on there? What kind of illumined household is that? All right, let me continue. All right, so he drew two conclusions from his work. The first was that a state of general equilibrium is theoretically possible. The second was that wherever an economy started, a free market could move it toward general equilibrium. So a system of free markets could be inherently stable. Walras showed how this might happen through an idea he called tautonement. I don't know how you pronounce that, but it's spelled tautonement, Tatonnement, tautonement, or groping. Walras showed how this might happen through an idea he called tautonement, groping, in which an economy gropes its way up to an equilibrium just as a climber gropes his way up a mountain. He thought about this by imagining a theoretical auctioneer to whom buyers and sellers submit information about how much they would buy or sell goods at different prices. The auctioneer then announces the prices at which supply equals demand in every market, and only then does buying and selling begin. Flaws in the model. Walras was quick to point out that this was simply a mathematical model designed to help economists. It was not intended to be taken as a description of the real world. His work was largely ignored by his contemporaries, many of whom believed that real-world interactions are too complex and chaotic for a true state of equilibrium to develop. On a technical level, Walras's complex equations were too difficult for many economists to master, which was another reason why he was ignored, although his student Vilfredo Pareto later developed his work in new directions. In the 1930s, 2 decades after Walras's death, his equations came under the scrutiny of the brilliant Hungarian-born American mathematician John von Neumann. Von Neumann exposed a flaw in Walras's equations, showing that some of their solutions produced a negative price, which meant sellers would be paying buyers. Hey, there you go. However, Walras's ideas have been rescued by the work of U.S. economists Kenneth Arrow and Lionel W. Mackenzie and French economist Gerard Debreu, who in the 1950s developed a sleeker model using rigorous mathematics. Developed a sleeker model. Using rigorous mathematics, Arrow and Debreu derived conditions under which Walras's general economic equilibrium would hold. They found that when people's decisions about buying and selling are rational, in the sense that they are consistent, then it is possible for all the markets in an economy to be in equilibrium. A requirement for consistency is the transitivity. A requirement for consistency is the transitivity of people's preferences. If you prefer apples over oranges and oranges over grapes, then you must prefer apples over grapes. I don't know about that. All right. Let me look at this one sidebar here. There's an image. Let's see, the caption here says, where prices are judged to be too high in one market, this will lead to an excess in supply in the market. Prices adjust to eliminate excesses in supply or demand across an economy in a process that Leon Walras called tâtonnement. That's groping. Prices are too high, there's an excess in supply, right? Because people aren't buying them, so there's too much of them left because people aren't buying them, okay? So high prices in the middle of the seesaw-looking thing, so got a fulcrum in the middle, right? And low demand, excessive supply, high price. Low price, then you have excess demand is high, and then there's a low supply, right? Because people are buying them all, so there's not a lot. And at the right price, demand and supply are balanced, okay? Sense. All right. Finally, we have the last section that's labeled computable economies. Computable economies. Improvements to computers in the 1980s allowed economists to calculate the effects of interactions between multiple markets in actual economies. These computable general equilibrium models, CGEs, applied Walras's idea of interdependence to particular situations to analyze the impact of changing prices and government policies. The attraction of CGE, that's computable general equilibrium, is that it can be used by large organizations such as governments, the World Bank, and the International Monetary Fund to make quick and powerful calculations showing the state of the whole economy, as well as seeing the effects of changing different parameters. Today, analysis of partial equilibrium, considering the forces that bring supply and demand into balance in a single market, is the first thing that an economics student learns. Today, analysis of partial equilibrium, considering the forces that bring supply and demand into balance in a single market, is the first thing an economics student learns. Walras's insights about general equilibrium also continue to generate work at the cutting edge of economic theory. For most economists, equilibrium and the existence of forces that return an economy to this state remain fundamental principles. These ideas are perhaps the essence of mainstream economic analysis. Reminds me of the alchemy of deep physics, high finance, and ancient religions of Babylon's banksters, for some reason. And finally, a quote. The equilibrium reestablishes itself automatically as soon as it is disturbed. Leon Walras. All right. That concludes this portion of this edition of World Reading Club's Wealth Attraction Research from the Little Book of Economics, the section titled A System of Free Markets is Stable, Economic Equilibrium. All right, moving on now. We have How Money Works. You've been listening to Wealth Attraction Research, presented by Hakeem Ali Bokus Alexander on Spreaker Social Podcasting. All right, now we're moving on to How Money Works. The section is called Day Trading. I know, boring, unless you're a day trader. But I've made a decision. I've committed myself to reading at least these 3 economics books cover to cover, and so I must continue. Day trading. Day trading is the buying and selling of shares, currency, or other financial instruments in a single day. The intention is to profit from small price fluctuations. Sometimes traders hold shares for only a few minutes. How it works. Investors typically buy or sell a share based on their analysis of economic or market trends, research into specific companies, or as part of a strategy to benefit from the regular dividends that companies issue. Unlike such investors, day traders look for small movements in prices that they can exploit to make a quick profit. They may hold shares only momentarily, buying at one price and selling when the price rises by a few cents, perhaps only minutes later. Day traders make profits by trading large volumes of shares in one transaction, or by making multiple trades during the course of the day. They buy or sell shares and then sell or buy them again before payment becomes due, and usually close out all trades, selling the shares they have bought and vice versa, at the end of the day to protect themselves from off-hours movements in the market. This is different from long-term investing, in which assets are held for longer periods in order to generate capital growth or income. There's a nice... this is supposed to be the fact visual explained, so I'm going to read what I see here also with the images. So it's liquid shares. Day traders favor shares that are liquid, those that are easy to buy and sell in the secondary market. And we have a big bank and profits are going up, and it says at market opening, a day trader looks at the price of big bank shares, knowing that the bank has just reported increased profits. Next, the trader buys 10,000 shares at $490, expecting that the price will continue to rise. By 10 a.m., the bid price has risen to $500. The trader sells, making a profit of $10 minus fees on each of the shares. Finally, the trader may make 5 to 10 similar trades within the course of a day. Right? That's what we just read. Continuing. Warning, warning, warning. High risk. Day traders typically suffer severe losses in their first months of trading, and many never graduate to profit-making status. Stress. Day traders must watch the market nonstop during the day, concentrating on dozens of fluctuating indicators in the hope of spotting market trends. Expense. Day traders pay large sums in commissions for training and for computers. And finally, need to know. Scalping. A strategy in which traders hold their share or financial asset, known as their position, for just a few minutes or even seconds. Margin trading. A method of buying shares that involves the day trader borrowing a part of the sum needed from the broker who is executing the transaction. Bid-offer spread. The difference between a price at which a share is sold and that at which it is bought. Market data. The current trading information for each day trading market. Rather than using market data that is available free of charge, but can be up to an hour old, day traders pay a premium for access to real-time data. Day traders must be able to trade on news or announcements quickly. Sneeze. Wow. Day traders must be able to trade on news or announcements quickly, so they need to watch the market and stay close to their trading screens at all times. Well, good. That was short, not necessarily sweet. That was day trading from How Money Works. And that concludes this edition of Wealth Attraction Research, Day Trading and Economic Equilibrium, presented by Hakeem Ali Bokus Alexander on Spreaker Social Podcasting, presented for World Reading Club in association with ExercisingYourMind.com and Uniquilibrium.